Welcome to the Business Broker Expert channel. I'm Dean Wiltsey, Managing Broker at Curtis Wiltsey. You've spent years, maybe decades building your business. It's your baby. But lately, you've started thinking about the next chapter. Retirement, new venture, or maybe just some well-deserved time off. But here's the thing. Selling a business isn't like selling a house. In 2026, the market is disciplined. Buyers are meticulous, and the gray tsunami of retiring owners means there's a lot of competition out there. There are 4 critical questions every owner wants and needs to answer. Let's break them down. Question 1, what is it actually worth post-tax? The first question is always the big one. What's the price tag? Most owners have a magic number in their head. But in today's market, buyers aren't just looking at your revenue. They're looking at EBITDA and predictability. But here's the secret question you should be asking. What do I keep after the tax man takes his cut? Between capital gains and deal structuring like assets versus stock sales, your headline price can look very different from your take-home pay. Get a professional opinion of the valuation now, not next year. You need to know if your business value actually supports your retirement lifestyle before you commit to the exit. Question 2, can it survive without me? This is a hard pill to swallow for many founders. If you disappeared for a month, would your revenue drop? Would your clients panic? If the answer to this question is yes, you don't have a business to sell. You have a high-paying job. Buyers in 2026 are looking for replaceability. They want documented, standard operating procedures that anyone can follow. A second command, a management layer that holds the keys. Customer diversification. If 40% of your revenue comes from one friend you've known for 20 years, that's a massive risk for a buyer. The less the business needs you, the more valuable it becomes. Question 3, what are the deal terms beyond the price? In 2026, the all-cash exit is becoming very rare. Owners often want to know, how long am I stuck here after the sale? Expect to hear terms like earnouts, where part of your pay is tied to the business's future performance. Seller notes, you essentially act as the bank for a portion of the sale. Transition periods, stay on for 6 to 24 months to hand over the reins. You need to decide early, are you looking for a clean break or are you willing to stay on to maximize the total payout? Question 4, who am I without this business? This is the most personal question. I've seen owners close a $10 million deal and feel depressed the next day. Why? Because they lost their identity. Before you sell, you need to know why. Are you running away from burnout, or are you running toward a specific goal? If you don't have a plan for Tuesday morning after the closing, the process will feel much more painful. Selling your business is likely the biggest financial transaction of your life. Don't treat it like a sprint. Treat it like a marathon that requires at least 2 years of training. Clean up your financials, empower your team, and get your why in order. We talked about the emotional and the strategic side of selling. Now we're getting into the numbers. The most common question I get is, what's my multiple? But here's the truth. A multiple is just a shortcut. In 2026, buyers aren't just looking at a number. They're looking at the quality of the earnings behind that number. Today, we're going to look under the hood of business valuations. We'll cover SDE, seller discretionary earnings, versus EBITDA, the add-back game, and the 3 levers you can pull right now to drive your price up. The foundation, SDE versus EBITDA. First, we have to speak the same language. Depending on the size of your business, you're going to be valued of one of two things. SDE, seller's discretionary earnings, and that's usually for businesses worth under $2 million. This is basically the total financial benefit to one owner: your salary, your profit, and your perks. EBITDA is for larger companies. It stands for earnings before interest, taxes, depreciation, and amortization. Why does this matter? Because a buyer looking at EBITDA wants to see what the business makes after paying a professional manager to run it. If you're doing the work of 3 people and not taking a market rate salary, your EBITDA and your value might be lower than you think. The art of add backs. Your tax return is designed to show as little profit as possible to save on taxes. But when you sell, you want to show as much profit as possible. This is where add backs come in. These are expenses that won't continue under a new owner. Things like the personal SUV the company pays for, or your family's health insurance, that one-time legal fee from 2 years ago, your excess salary above what a manager would cost. The warning is, be honest. In 2026, due diligence is digital and forensic. If you try to add back your personal groceries as a business expense, you'll lose the buyer's trust and the deal. The multiple mystery. So you found your adjusted earnings. Now what's the multiplier? Is it 3, 5, 10? In the current market, your multiplier is a reflection of risk. High risk, low multiple. Low risk, high multiple. So what drives the multiple? On this chart, you'll notice 3 columns. On the left is factor, in the middle decreases value, and on the right is increases value. So the factor of owner involvement, when the business relies on you, it decreases value. When it runs on systems, it increases value. Under revenue type, what decreases value are one-off projects. What increases value are recurring contracts. And growth trend, what decreases value is flat or declining numbers, and what increases value is growth of 10 to 15% year over year. If you're in a hot sector like AI, integrated services, or specialized HVAC, your multiple might be a full point higher than the guy down the street. There are 3 levers to raise value today. You can't control the economy, but you can control these 3 things before you list. Clean up your books. Have at least 2 years of clean financial statements. No commingling of personal funds. Reduce customer concentration. If any one client or supplier accounts for more than 15% of your business, start diversifying now. The owner vacation test. If you can go to Hawaii for 2 weeks and not check your email, your multiple just went up. Valuation isn't an exact science. It's an opinion backed by data. The goal is to make your data so compelling that the buyer's opinion matches your magic number. If you like this, please like and subscribe, and I'll see you at the next episode. Thanks for watching.